Hey everyone, welcome into another exciting edition of Market Takes. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. I'm Dion, Rabouin, reporter at the Wall Street Journal. Today we are breaking down the latest PCE Personal Consumption Expenditures report. It's all about inflation. This is the Fed's favored inflation reading, and we are going to get into just what it said, what it means, and what this tells us about the market, about the Fed, about the economy, all those things moving forward. So we're going to talk about what the report said, how that compared to expectations. We're going to talk about the big takeaways from this report. I think this report had some very interesting takeaways, and we're seeing the market and investors do some very interesting things right now. Today is one of my favorite days. We get this report where the response from the market doesn't really make a lot of sense, but it tells you a lot about what's happening in the world. So I'm very excited about what we're going to get into today. We're going to check in with the market. I'll talk to you about what we're seeing in stocks, bonds, currencies, commodities, all that good stuff. We'll talk about how this report aligns with other data we've seen, specifically other inflation data, but some other things. And then we're going to talk about what comes next, because you know, here at Market Takes, we are always looking forward, even though it is backward-looking data. So listen, let's get into it. Let's talk about what we saw in the report. This PCE report today came out. Let's throw a chart up here on your screen, first of all, so you can see what I'm seeing. This is the long term going back to 2021, right? And that's important because the number we got today, PCE inflation, came in 3% year over year. That was the lowest that we had seen since all the way back in 2021. You look there, this report, the lowest we'd seen in quite some time. So this is important because it shows the trajectory of inflation coming back down. As you can see there, inflation was kind of starting to pick back up a little bit on this inflation gauge. You saw it rising back towards 4%. Well, it has now fallen back to 3%. We got 3% inflation, and that is big for the report. That's big for the Fed. We'll talk about all that in just a moment. But really, this chart that you're seeing on your screen just illustrating the overall change that we have seen in inflation coming back down, doing what the Federal Reserve wants, what shoppers want, what markets want. This trend, this trajectory is a good thing. Now, when talking about the Fed talks about PCE, but the Fed likes to focus on core PCE when you strip out those food and energy prices, which can be very volatile. So let's throw that up here on your screen as well. Take a look at core PCE. And again, doing a similar thing, right? But unlike that overall PCE number in that chart that we were just looking at, you see this one just coming consistently down. You see it's moving downward. And again, last month was higher than the month before, and now we are moving lower. And so you got about 3.5% PCE for the month, and that compared to expectations, 3.5%, 0.2%. So right on the nose of expectations. Economists had expected for inflation to move lower and to continue moving lower into this month, and that's exactly what we're seeing. We are seeing inflation decline or come down on both a core and overall basis, meaning oil and gas prices are coming down, food prices are coming down, but so is everything else. And when I say coming down, I don't mean the prices are getting lower. I just mean they are rising at a slower pace. We still do have 3% inflation in the economy, and that's what you're seeing right there up on your screen. Core PCE for those things like housing, like overall prices, that's still rising about 3.5%, but much slower than that 7 or 5.5% level that we saw in the middle of 2022. So again, this chart just illustrating that overall, long term, when you take a big picture look at the economy, inflation is slowing down, not rising as fast as it has been. So let's talk about the big takeaways from this report, right? The big headline takeaway that everyone is talking about, that you're probably seeing in headlines, seeing on your Twitter feed, or excuse me, your X feed, if you will, is that inflation has slowed down. This is the slowest inflation has been since early 2021. And that's the big picture, right? We've seen this consistent decline in inflation, slowing on an overall basis. That had been giving initially stock and bond prices a big tailwind. Over the past month, we have seen stocks rise higher. We've seen those bond yields fall, which means bond prices are falling. That's a good thing generally if you're an investor, because you are seeing really an increase in prices. And what people are doing is they're betting that the Federal Reserve is going to start cutting interest rates. That's going to loosen up the economy. That's going to mean that these businesses are making more money. People are going out spending more. And that's another thing that we got in this report, is some indications. We're going to get into that in just a moment. But the big picture takeaway from this report inflation is slowing down, and that has a lot of consequences for the overall economy, for markets, stocks, bonds, all kinds of assets, and that's the big picture. CPI inflation, the other big inflation gauge that's more popular with the general public, more watched, that fell to 3.2% last month after being 3.7% the previous month. So when we look at these reports, we're seeing the same thing. We were seeing for a while sort of CPI higher than PCE, and that's still true a little bit. But then for a while we got CPI lower than PCE, and there was some wonder like, okay, are some of the things in the PCE report, the way that the PCE report measures inflation, is that potentially telling us that inflation is actually higher than we expect? Well, that's why one report or 1 month does not make a trend. The trend is still telling us inflation is coming down, it's slowing, right? The Fed funds futures market shows that investors are really taking a lot from this. And when we look at the Fed funds futures market, I'm looking at it right now, you're seeing expectation for the Fed to start cutting rates by its second meeting of the year. We've got about a 40% chance of the Fed cutting rates, a 44% chance now, looking at the market live on CME, the CME market, and that's the Fed fund futures market. That's showing, and now it's back down to 40. Anyway, I shouldn't try to keep up with this live, but seeing a 40% chance of a cut by the Fed in March. That is huge because the Fed has not said we're going to cut rates. The Fed hasn't said we're ready to start cutting rates as long as inflation behaves. What the Fed has said is inflation is too high. We need to get it back to 2%, not 3%, 2%. And then we can start cutting back rates, reducing rates. But the market is getting out ahead of that. The Fed is the market is saying, no, no, no. Again, we don't believe you. We don't believe that you're going to keep rates this high. We think you guys are going to start cutting very quickly, very soon. Market is seeing no likelihood of a rate hike next month at its meeting in December. 96% chance the Fed doesn't raise rates at its meeting on December 13th. That's up from 74% just a month ago. So the market is saying rate hikes are out. That's over. That story's done. Rate cuts are what's coming, and rate cuts loosen up the economy, makes it less expensive to borrow money, gives people more money in their pocket, gives businesses cheaper financing so they can borrow money for less, and that makes their balance sheets look better. That means they've got more to go out and hire, do things like that. So again, we are seeing the markets really price in that all this is what's coming from the Fed, not in a long time, not way down the road, not in 2025, but next year and really just in a couple months at its second meeting of the year in March. That is big. Investors pricing rate cuts into June is what we were talking about just a couple weeks ago, and that was a huge trend. We had seen investors really pricing out those rate hikes potentially going into next year. So this is a massive sea change. What we've gotten today and what we've gotten really over the past few weeks is a huge sea change in terms of sentiment and expectations for what comes from the Fed. And if you watch market takes, if you follow the markets, you know that the central banks and the Fed are everything. That's what it's all about. That's what's moving everything. And what we have seen over the past few weeks and in a big way today is a pricing of more rate cuts, pricing out of rate hikes. That's big. Speaking of, let's take a look at what's going on in the markets right now. I want to throw up here on your screen WSJ.com and what we're seeing from the markets. And if you notice there, the Dow is still up, but the NASDAQ, which has been on a tear, up over 30% this year, and I think up over 35% year to date, well, it's a little bit lower. The S&P right around flat, but a little bit lower. And I think what you're seeing there is it could be one of two things. It could be a little buy the rumors, sell the news. What that means is when you start getting word, oh, the PCE report's going to be strong, then investors kind of say, okay, well, based on what we've seen, we think inflation's going to keep coming down. Let's buy stocks. And then when it actually comes in, it's like, okay, well, we've seen the appreciation come in. We've seen prices move higher. Now we're going to sell. Now we're going to get out because we've realized what's happened. We've gotten the news. We bought on the rumor. We expected for inflation to keep coming down, keep moving lower. Now we're going to sell. The news comes out and confirms that our position was right. Let's get out of these positions. Another really interesting thing has been what we've seen in the bond market. And the bond market is a bit of the same thing. You've got bond yields moving higher, which means prices are moving lower. And you saw this move really accelerate after the release of this PCE report. So you got the PCE report being released right around here. You had the 10-year down at about 4.28, and now you see it about 4.33. So bond yields were moving higher really right after this report came out. And then the stock market, which opened up at 9:30, initially went higher on the positive reading and then moved lower. And so we're seeing really the stock market kind of follow the bond market. Another interesting market happening that we saw today was currencies, right? We're seeing the euro down in a big way, which means the dollar is up. But take a look at the dollar index. You are seeing just a big time increase. And that, again, you saw the market sort of move down ahead of the release, and then that PCE report came out right around here, and then you see it just kind of move higher. And now the dollar index is up pretty significantly. WSJ dollar index, which measures the dollar against more currencies, that's up in a big way as well. So the dollar index, when you look at the currency markets, they're still factoring in, okay, the dollar is going to be stronger. Those bond yields are going to be higher. And that's a very interesting thing when we think about the way that inflation has come down. And really, what we're seeing from the market just kind of illustrating the overall theme in markets, which is a bit of this potentially buy the rumor, sell the news. But it could be that maybe the market is thinking, okay, maybe the Fed's not going to act as quickly as we think. When you're seeing these Fed fund futures markets, we're seeing investors really pricing in a big move from the Fed. But what you're seeing from the market is a potential, all right, maybe this is a little bit overdone. Maybe the rally is going a little bit too far. Maybe inflation's coming down, but it's not going to get to the Fed's 2% target as quickly as everyone thinks. Could be that, or it could just be a little buy the rumor, sell the news. Want to quickly point out the Fed has not said that they are on board with rate cuts. In fact, Fed Governor Michelle Bowman said just yesterday that, quote, her baseline economic outlook continues to expect that we will need to increase the federal funds rate further to keep policy sufficiently restricted to bring inflation to our 2% target in a timely way. Blah, blah, blah. The big picture there is that Michelle Bowman, who's on the FOMC, she's a voter, she gets to a say in what happens. She's saying, not only do I not think rate cuts, I'm thinking rate hikes. I'm thinking we need to raise rates again. And this was just yesterday. So she had seen the CPI report. She'd seen unemployment continuing to kind of go down, these jobs numbers coming down from their highs. She's seen all the data, and likely she had seen this PCE report because remember, the Fed gets some of this data early, government officials get that data early. So those comments came with the knowledge of what's happening with the slowdown in inflation. And she still says we need to, my baseline expectation, meaning what she thinks will happen if nothing crazy happens, is that we will need to increase the federal funds rate. That's big. You also had Powell come out and say the Fed plans to hold rates higher for some time. You had New York Fed President John Williams out today saying he doesn't really see rate cuts coming. So the market could have something, maybe an unexpected surprise. The Fed's next meeting, December 13th. We'll be right here on Market Takes, breaking all that down for you. But again, the summary of economic projections of that meeting will be huge, and you'll want to be right here. We'll be breaking all that down, explaining what it all means. Let's also throw, since we're talking about it, let's put up the CPI, Consumer Price Index. That's the other inflation gauge. This one the Fed doesn't watch as closely because they like the way PCE measures it. But again, you see the same thing, right? And when I talk about what Fed Governor Michelle Bowman had said yesterday, she knows this information. She's seeing inflation come down. That's inflation about 3.2% on the CPI. But again, moving back toward the Fed's 2% target, moving further away from CPI rose to as high as 9% back in 2022. We are very far from that right now. So that chart just illustrating what we have seen from CPI, similar to what we had seen from PCE, which is the report that we got out today. Really quickly, let's dig into the report. Prices for goods decreased 0.3% for the month, where prices for services increased by 0.2%. This is big because we are seeing goods prices continue to decline. That was what really shot inflation up. Used cars and trucks, new cars and trucks, all those big durable goods and things like that, those pushed inflation higher. That's coming down. We're seeing services inflation pick up. That's restaurants, bars, law firms, your dentist's office, all those things, those services that people provide, we're seeing those prices go up. Also, food prices increased 0.2%. Energy prices decreased 2.6%. So we're seeing oil, gas, all those things, those prices are decreasing, but we're seeing food prices, services prices, all those things rising. The personal savings rate, my man Gregory Dacko over at EY says that savings rate continues to be unsustainably low, down to 3.8%. That is well below the long-term average. Actually up from May, but again, well below the long-term average. Most interesting thing I saw in this report was the personal income, which is the personal income and outlays report. The inflation-adjusted disposable personal income actually it had been negative 3 months in a row, July through September. Well, those were all revised to zero, and then October's report showed an increase of 0.3%. So people actually were making a good deal more money over the past few months than initially anticipated. So we could be seeing even more money flowing through the economy. That could push inflation higher, but it also means that maybe things aren't as dire as folks had thought previously in terms of the way that Americans' wages are falling and declining. So according to the revisions, people have been making more money than we thought. The big thing to watch going forward is going to be services. What happens with services? Do those prices keep rising, and does that put pressure on inflation moving back higher? Core versus overall, that's going to be something to watch, but the big picture moving forward, you're going to want to watch services. We got a big services report coming out next week. S&P's Purchasing Managers Index on the services side. Next Tuesday, that's going to be something you'll definitely want to watch. So the Fed's favorite gauge says inflation is down to 3%, says core is down to 3.5%. What are they going to come out and tell us over the next few days, and what are they going to tell us at their meeting on December 13th? Looks like inflation is coming back towards target, but is clearly not there yet. If the Fed is not planning to cut rates next year in 2024, at least not planning to cut rates at its second meeting of the year, they're going to need to communicate that. And that communication could have a pretty negative effect on stocks, bonds, all kinds of other assets. So you're going to want to watch for Fed communication. You're going to want to watch that Fed meeting. All of those things. One thing I want to point out here, and let's throw another chart up here on your screen, the Atlanta Fed's wage growth tracker. That's shown a consistent move back down and move lower in wages. This is wage growth, right? How much are folks' wages rising and growing? That's been coming down, but again, it stabilized in October. And that's the theme that we saw. We had seen for a long time, and this has been consistent with the negative sentiment that we've seen. We've seen wages coming down along with inflation, but not moving lower at the same pace of inflation. So people feeling like, ah, man, I'm not getting those same big raises I was. I'm not being able to demand as much of a big salary increase if I move to a new job. And this chart here, the Atlanta Fed's wage growth tracker, really just illustrating the way that wages have moved lower overall when adjusted for inflation. We also had been seeing that in the latest CPI report, showed real average earnings, real average weekly earnings fell in October. We had also seen that from the PCE report, but again, we've seen that reverse, and now real wages rising, moving up, inflation adjusted wages. That's big. So what comes next? Well, like I told you about that S&P Services PMI, that comes out on Tuesday. The manufacturing version will be out tomorrow. You'll watch that, but the big one is going to be services next week. Definitely will be a big one for inflation, for sentiment. Of course, next week I will be out, so I won't be with you, no market takes, but we will be right back here on December 13th. That's Fed Day, the FOMC meeting. We'll be breaking down everything you hear from Powell, what we hear in the statement, the summary of economic projections. Is going to be a party, so I hope you'll be with us right here on Market Takes. Before I get out of here, I got to plug my podcast. Check it out, WSJ's Take on the Week. We are cutting through the noise to explain the major business and financial news that can move the markets. Also, you can make smarter investing decisions. Subscribe, listen wherever you get your podcast, Apple Podcasts, Stitcher, Spotify, whatever you do. Check out WSJ's Take on the Week, hosted by me. And listen, that's going to do it for us here on Market Takes. Thank you so much for being with us. I am Dion Rabouin, reporter at the Wall Street Journal. We will see you next time.